Welcome to the deep dive. Today we're pulling back the curtain on Red Robin Gourmet Burgers' recent Q1 2025 earnings call.
Yep.
Our mission, like always, is to cut through that transcript, pull out the key signals and just give you a clear picture of what's actually happening with the company.
That's right. And looking at the initial headlines from Q1,
Yep.
You might see some positive stuff on the surface. Revenue was up a tiny bit, profitability looked pretty strong.
Right.
But when we really dug into the details on the call, a more complicated picture starts to emerge, especially when you look at guest traffic and the outlook for the rest of 25.
Absolutely. So let's just quickly hit those headlines before we dive into the nuances. Q1 2025 total revenue came in at $392.4 million. That's a small bump from $388.5 million last year. So growth, right, on the surface.
Correct, yeah. And the comparable restaurant revenue growth, the number you often see highlighted, that was reported at 3.1%.
Okay, now let's unpack that 3.1% comp growth, because this is where, it gets interesting. It wasn't driven by more people eating there. Actually, guest traffic was down 3.5% in the quarter. So the growth came almost entirely from pricing, a big 6.8% increase in net menu price. Basically, making more money per check, which offset fewer people coming in.
And that strategy, you can really see the impact on profitability. Restaurant level operating profit, as a percentage of restaurant revenue, it jumped to 14.3%. That's a really significant increase, 330 basis points better than Q1 2024.
Wow, 330 basis points. So for folks maybe less familiar, that's like a 3.3 percentage point improvement right there at the restaurant level. That's pretty huge. What drove that?
Well, management pointed mainly to cost efficiency gains, particularly labor. They mentioned the operations teams got labor costs under control faster than they thought they would.
Okay.
So really effective labor management, plus, of course, the benefit from those price hikes we just talked about.
Gotcha. And then outside the restaurants, we saw some shifts too, right? G&A costs, general and administrative, they were up a little. $27 million versus $25.8 million.
Yeah, slightly up. But selling expenses actually dropped quite a bit, down to $9.4 million from $13.5 million.
Okay, why the drop there?
That was linked directly to spending less on media in the quarter.
Yeah.
They were apparently overlapping some specific marketing tests they ran the year before.
Oh, okay.
And all this cost control, especially the operational wins and the pricing, it really flowed through to adjusted EBITDA. That number hit $27.9 million for Q1 25. That's a jump of $14.5 million over Q1 24.
Right.
So just EBITDA, that common profit measure before interest, taxes, depreciation, amortization, it really underlines that story. Manage costs, benefit from higher prices.
So Q1, impressive profit gains, but that traffic softening is definitely a flag. Now let's talk about the big leadership change announced on the call. GJ stepping down, Dave Pace taking over as CEO.
Yeah, this was framed as a very smooth, very collaborative handoff.
Yeah.
Dave Pace isn't exactly new, right? He's been chairman of the board since 2019.
Oh, okay. So he knows the playbook. Exactly. Deeply involved, already familiar with the turnaround plan. So it's less like an outsider coming in and more, someone stepping up from within, building on that relationship with the previous CEO.
And it sounds like they made a point of saying, the foundation built under the prior leadership was pretty solid before this switch.
Absolutely. They flagged several key things. Making Red Robin more focused on operations was a big one, especially through that managing partner program.
Right. The incentive program for the restaurant bosses.
Yeah, tying their rewards to balanced financial results. They also talked about elevating the guest experience, investing in things like flat top grills for, better burgers, improving hospitality with better staffing models. They actually said guests are starting to notice and appreciate it. It's key.
And the loyalty program revamped from last year. That was a big deal, wasn't it? Yes. Getting that relaunched loyalty program working better was highlighted. The idea is faster rewards, encourage people to come back more often. Seems to be working. They had about 15.3 million members by the end of Q1. So building that base was part of the foundation.
Okay.
And finally, just driving that comp revenue and unit profit growth late last year and into Q1, the numbers we just discussed, those also credited to the efforts under the previous CEO.
So with all that context, what's the new CEO, Dave Pace's sort of initial high-level plan? What's his vision building on this?
He laid out four main priorities. First, keep the operational progress going, even extend it. So consistent high-quality guest experience, keep finding efficiencies.
Makes sense.
Second, this is probably the biggest challenge looking at Q1, getting back to sustainable traffic growth. He actually used the phrase bend the curve on the traffic decline.
Okay, so traffic is priority number one, basically.
Seems like it. He stressed needing to be bold and creative with marketing. Third priority, strengthen the finances, reduce debt, generate more free cash flow, build flexibility. And fourth, reinvest in the restaurants themselves, making sure the physical space, the atmosphere, matches the food and service upgrades.
Okay, and to tackle that marketing challenge, that bold and creative part, did they mention bringing anyone specific in?
They did. They highlighted bringing in Russ Klein for a one-year term. His job is basically to build a marketing foundation and strategy. Apparently, he's got a track record helping known brands reconnect with customers.
Interesting. So a focused hire for a specific problem.
Exactly. Fits right into Pace's goal of driving traffic and making Red Robin, the go-to burger place again.
Let's shift gears then, look at the balance sheet. How's the company's financial health, specifically the debt picture?
End of Q1, they had $24.2 million in cash, plus another $9.1 million restricted cash, and $35 million available on their revolver line.
And are they actively paying down debt?
Very much a priority for 2025. They used free cash flow from Q1, plus they sold 3 properties they owned for about $5.8 million.
No, okay. Monetizing assets?
Yep. Altogether, they paid back about $17.8 million of debt. That brought the outstanding balance under their credit agreement down to $171.7 million at quarter end.
So actively chipping away at it, they've got that term loan due in Q1 2027? How are they feeling about refinancing that down the road?
Management sounded pretty optimistic. They think the strong Q1 results should help their conversations with lenders. They emphasized, though, they're balancing trying to get it done with getting good terms, not just rushing into anything.
Makes sense.
They also mentioned they still own 4 properties, so that's a potential future source of cash if needed, though nothing planned right now.
All right, so Q1 looked strong profit-wise, traffic's a concern. What about the outlook for the rest of 2025? Did they update the full year guidance?
Yes, they did. They trimmed the outlook slightly for total revenue for the full year, now looking at $1.21 to $1.23 billion. That's down a bit from the prior $1.225 to $1.25 billion range.
Okay, a little haircut on the top line expectation. How does that filter down to comparable restaurant sales? Are they expecting declines now?
Actually, no. They're still expecting annual comparable restaurant sales to be basically flat, around 0%. That's in line with what they said before.
Huh. So lower total revenue, but flat comps. How does that work?
The slightly lower total revenue seems to reflect an updated expectation on the number of restaurants they'll have open. They plan to end 2025 with 393 company units, which is 14 fewer than they started the year with.
Ah, okay. So unit count changes are part of that lower total revenue.
Okay.
What about the profit targets then? Did those come down too?
Nope, good news there. Restaurant level operating profit is still expected between 12% and 13%, right in line with prior guidance.
Okay.
And adjusted EBITDA guidance, also holding steady, still $60 to $65 million. One number did tick up slightly, capital spending, now expected around $30 million, maybe reflecting some of that reinvestment Pace talked about.
It still feels a bit, counterintuitive. Lowering revenue guidance, but keeping profit targets flat. What's the thinking? How do they bridge that?
They pointed the finger for the slightly lower revenue, specifically at the broader macro environment and consumer pressures. Their guidance now assumes that the traffic trends they've seen lately, running around a 4% decline, will probably continue for the rest of the year.
So they're baking in continued traffic weakness.
Yeah. That expected traffic decline is really the main reason for the slightly lower top-line forecast. The flat comp guidance implies they expect pricing and maybe some mix shift to offset that traffic drop over the full year, even if total dollars are slightly less due to fewer stores and overall caution.
Are they seeing any cost pressures coming up? Tariffs or anything?
Yes, the guidance does factor in a cost headwind from current tariff policies. But interestingly, they made a point of saying they are not planning any more menu price increases for the rest of 2025.
Really? After that big Q1 hike?
Yeah. They're prioritizing keeping value perception strong for guests. The plan is to absorb those tariff impacts through more cost savings from the operators, building on those Q1 efficiencies.
That's a deliberate choice then. Hold the line on price, even with costs rising. What about selling expenses for the year, especially with the new marketing guy coming in?
They expect selling expenses to be around $30 million for the full year, which is consistent with what they originally guided.
Okay.
It suggests a pretty steady spend level from Q2 through Q4. They said this gives the new marketing lead, Russ Klein, time to get his feet wet and figure out the plan before, potentially shifting spending significantly.
Looking just at the immediate future then, the second quarter, Q2, what are they saying there?
For Q2 specifically, they expect comparable restaurant sales to actually decline by about 3%.
Decline. Okay, why the dip just in Q2 after a positive Q1 comp?
Well, that number needs some context. A big chunk of that expected decline, about 240 basis points worth, comes from lapping changes related to the loyalty program launch back in Q2 of 2024.
Ah, okay. Some kind of accounting thing from the launch last year.
Exactly. There was some sort of one-time accounting benefit for how loyalty revenue was recognized last year that makes this year's Q2 comparison look artificially tougher. Even if the program is doing okay now, they'll also have less benefit from those menu price increases in Q2 compared to Q1.
Right, the big hike was already in place for Q1, so the loyalty program itself isn't necessarily seen as failing in Q2. It's more about the tough comparison from last year's launch.
That's how management framed it.
Yeah.
They said they feel the program is working. They highlighted getting more visits from lapsed users. That's 22% of visits now, and new guests, about 20% of visits. Membership's still growing. They think there's still a lot more they can do with the program. Leverage it better.
Okay. Let's touch on the restaurants themselves. Any more detail on closures or investments in the actual buildings?
Yeah, they expect to end 2025 with 393 company-owned spots. That means closing 14 units over the year. They said the closures should be spread out pretty evenly through the rest of the year.
Okay.
Though they did add there's potential to speed some up if talks with landlords go well.
And what about those locations they'd previously flagged as maybe needing to close? Any progress turning those around?
They actually sounded pretty encouraged there. They said significant progress has been made, improving performance in many restaurants that were on that sort of watch list.
Oh, really?
Yeah. Too early to say which ones might come off the list for good, but they're seeing broad improvement, including in many of those potentially marginal units.
That's interesting, improving performance even in places they thought might have to close. What are the operators, the people actually running the restaurants, telling leadership they need most right now?
Based on recent talks, the top requests are for continued investment in the facilities and technology. Specifically, server handhelds came up.
Ah, the tablets for taking orders and payment table side.
Exactly. Seen as a tool that would really help operators right now with efficiency and service. Ties right into that strategic goal of reinvesting in the restaurants.
Makes sense. Anything else?
They also stressed wanting compelling marketing messages and offers to drive traffic. They know they'll get rewarded if they succeed because of that managing partner program. So they sound ready to deliver if marketing can just get more people in the door.
Okay. So wrapping all this up then, what's the core tension or the key takeaway for you from this call?
Well, if you connect the dots, you've got a company that executed really well in Q1 on costs and pricing. Boosted profits significantly, even though traffic was down.
Right. Strong execution on things they could control internally.
Exactly. But the look forward is much more cautious. They expect those traffic declines to stick around, which trims the revenue forecast a bit. And they face cost headwinds they plan to absorb, not pass on with more price hikes.
The strategic plan under the new CEO seems clear, though. Lock in the operational wins, fix the balance sheet, reinvest where needed. But the absolute number one priority is figuring out how to get traffic growing again sustainably.
Yeah, that's the crux of it.
And the leadership change seems smooth. Someone familiar stepping in, keeping the operational focus, but recognizing the urgency on traffic and bringing in help for that.
Which brings us back to that really interesting question, doesn't it?
Mm-hmm.
Red Robin, improved operations, they have this revamped loyalty program, yet they still expect traffic to decline for the rest of the year. What does that tell us?
Yeah.
Is it about the wider casual dining scene? The burger segment specifically? Are consumers just feeling pinched? Is this a Red Robin specific issue? Maybe their value isn't resonating right now. Or are they just like the canary in the coal mine showing broader pressure? It definitely stands out from the call. Something to really think about as you watch this whole sector going forward.
A really fascinating tension to watch unfold beyond Q1. Well, thank you for joining us for this deep dive.
Yeah, our goal here was just to distill those key insights from the earnings call, give you concise but clear picture of Red Robin's situation and outlook.
We definitely encourage you to keep exploring based on what we've talked about. Thanks for listening.
And we look forward to the next deep dive.